The majority of business owners are sole proprietors or LLCs, and occasionally business owners are trying to figure out, should I continue to be an LLC? Shall I convert to an S corporation? When is it appropriate to change to an S corporation? In today's video, we're going to learn about the benefits of LLCs filing taxes as an S corporation. Let's get started. According to the Tax Foundation, only 13% of all businesses are actually S corporations, and 80% of newly formed businesses are sole proprietors and partnerships. According to my calculations, this indicates that 80% of businesses may be paying more taxes than necessary, but only if they are making more than a certain amount. I'll explain what that amount is to you in a moment. However, I must make sure you are aware of how LLCs are taxed in the first place, in order to decide whether switching to an S corporation can save you money and ultimately decide whether to make that switch. So let's say you recently launched a business. Well, the moment you make $1, that money is viewed by the tax code as taxable income. The money you spent to earn the money is normally deductible, but all the money you receive is taxable. As a result, you are essentially only paying taxes on the money your business actually made during the tax year after deducting its expenses. No matter your legal form, LLC, partnership, or S corporation, all business income is handled the same way. The main distinction is in the kind of taxes you owe and how they are applied to your net income. Let's assume that you're a sole proprietor, partnership, or an LLC. When you file your business tax return, 3 different types of taxes will be applied to your income. In this case, first, the federal income tax you pay the IRS. The second item is your state income tax, which is paid to your state if applicable. The third item is your self-employment tax, which is paid to the IRS for the Social Security and medical programs. Depending on the tax bracket that your taxable income falls into, both your federal and state income taxes will change. However, there is also a self-employment tax. You are required to pay Medicare and Social Security taxes because you are self-employed. What trips most people up is not once, but twice. As an employee, you typically withhold 7.65% of your pay as Social Security and Medicare taxes, and the employer is required to add 7.65% tax to that amount as well. However, because you work for yourself, you are required to pay both the employer and the employee portions of self-employment taxes, which results in a flat rate of 15.3%. In other words, you would pay over $15,000 in self-employment taxes on $100,000 in income, not including any federal or state taxes you would also be required to pay. A single taxpayer in the 24% federal income tax bracket makes $100,000 a year. It follows that you would owe an additional $24,000 in taxes if your state tax on an additional 5% tax. That's $5,000 more money out the door. Out of the $100,000 in business profit, not your revenue, you are suddenly down to $56,000. It also makes you feel like the government received equal compensation for the work you did for your company, which is a bad feeling. Fortunately, you have a choice in the matter, and choosing to become an S corporation is one of them. Since you aren't technically self-employed, S corporations are exempt from paying self-employment taxes. Your corporation would be a distinct entity that employs you if it were an S corporation. I'll go over that math in a moment. However, let's define an S corporation first. The S corporation designation is a unique tax status given by the IRS that permits corporations to avoid double taxation and pass through their income to their shareholders, similarly to LLCs, sole proprietorships, and partnerships. An S corporation, however, is not a legal entity, just to be clear. To choose SCorp status, you need to be a legal entity. For tax purposes, LLCs and S corporations, for instance, can choose to be treated as S corporations. All you need to do to become an S corporation is to submit Form 2253 to the IRS. If you are approved, you will then submit Form 1120S when you submit your tax return. Okay, so going back to the tax situation mentioned earlier, S corporations are exempt from paying self-employment taxes as long as they follow one key regulation. Before receiving distributions of profits, S corporations owners must first pay themselves a fair wage for the work they perform in the company. The best way to approach this is to consider both yourself and your business as separate entities. In that case, you would receive a distribution for your assets and a W-2 salary for the work you do. Payroll taxes, including Medicare and Social Security taxes, would apply to the W-2 salary you receive. However, the concept behind this is that you are only being taxed on the portion of your business income that can be directly linked to you in the form of wages, as opposed to being taxed on all of it. Therefore, you won't be required to pay any self-employment taxes on the distributions you receive. So let me allow you to give you an example here. Let's say that your company had a net income of $100,000. Moreover, suppose you paid yourself about $35,000 in W-2 wages. In this instance, Social Security and Medicare taxes would apply only to the $35,000 in wages. Therefore, instead of paying 15.3% tax on $100,000, you only have to pay 15% tax on $35,000, or roughly $5,300. But hold on, let's pause for a moment. You would have paid $15,300 in self-employment taxes on $100,000 income in the first example I gave you as an LLC. However, in this case, if you had an S-Corp, you would only have to pay $5,300 in self-employment taxes on the same $100,000 of business income. As you can see, even something as basic as the entity you choose can save you tens of thousands of dollars in taxes. The question of what is reasonable compensation for S corporations is one that we frequently get asked here. In a different video, I went into great detail about this, so make sure you check that out and subscribe to our channel. However, a fair payout to shareholders is typically at least 1/3 of the company's profit. There are, however, a lot of factors to take into account, so be sure to watch my video on that subject. And finally, when does it make sense to change from an LLC to an S corporation? Generally speaking, switching to an S-Corp becomes more advantageous to you from a tax perspective once your business generates over $50,000 in net income. And just to be clear, I'm talking about net income here rather than revenue. If your revenue is $200,000 but your profit is only $25,000, probably isn't worth your time to apply to become an S-Corp. And this is why paying more fees as an S corporation makes sense. Due to the fact that you are not filing as a corporation as a whole, your tax preparation costs will rise. Additionally to filing your personal tax return, your accountant might even charge you to file the form that will help you initially become an S corporation. In addition, there are numerous other fees to take into account, including annual state fees. Therefore, if your company is not generating a sizable amount of revenue, it usually does not make sense to do all these things. However, if your company's net income is less than $50,000, I advise keeping operations as straightforward and lean as possible by operating as a sole proprietorship, partnership, or an LLC. You can probably save some money by choosing to become an S corporation if you want extra legal protection and have the net income of more than $50,000. So hopefully this aids you in your quest to reduce taxes and amass wealth. And that's it. If you don't want to miss out on more ways to do this, then be sure to subscribe to our channel for more content like this. And if you enjoyed our video, please help me out here by clicking that like button below. Thank you for watching, and I look forward to seeing you in the next episode.